All right, if you're tackling the NISM Series XB exam, you know capital gains is a big one. It's a topic you absolutely have to nail. This is all about the tax you pay on profits when you sell an asset. And trust me, understanding these rules is key, not just for the exam, but for making way smarter investment decisions down the line. So let's break it down and get you up to speed.
So here's the game plan. We're going to start with the absolute basics. What even is a capital asset? Then we'll get into how to classify it, what actually triggers the tax, and then we'll walk through the math of calculating your gains. And of course, we'll finish with the best part, the totally legal ways you can lower that tax bill.
Everything, and I mean everything, starts right here. Before you can even think about a gain or a loss, you've got to know if the thing you sold is considered a capital asset in the first place. So what makes the cut?
The official definition is, well, it's incredibly broad. Notice that wording, property of any kind. That's huge. It means it covers pretty much everything you own, whether it's for your business or for your personal life. But, with taxes, the exceptions are just as important as the rule itself.
Okay, this is where that broad definition gets really specific. On one side, you have all the usual suspects, right? Real estate, stocks, valuable art, that kind of stuff. But on the other side, the law specifically carves out some really important exclusions. Things like your business inventory, most of your personal belongings, and rural farmland. Those are not treated as capital assets for tax purposes.
And here's a super important distinction, a real gotcha for the exam. While your everyday personal stuff like your car or your sofa is excluded, the items you see here, jewelry, paintings, sculptures, are specifically included. Why? Because the tax department sees these not just as personal items, but as potential investments. And that means if you sell them for a profit, you could be looking at a capital gains tax. So, you've confirmed you've sold a capital asset. The next and absolutely critical question is, how long did you own it? The answer to that question decides if your gain is short-term or long-term. And believe me, that difference can have a massive impact on your tax bill. Now, the holding period isn't the same for everything. For actively traded things like listed stocks and equity funds, the magic number is 12 months. Hold it for more than a year and it's long-term. But for other assets like unlisted shares or real estate, you've got to hold on for more than 2 years to get that long-term status. Anything less than these timeframes, it's automatically short-term. And here's a little curveball to remember for your exam. Certain assets, especially depreciable assets used in a business, are always treated as short-term. It doesn't matter if you've held them for 10 years. Any gain you make on them is going to be a short-term capital gain, period.
Okay, so we've identified the asset, we've classified the holding period. Now we need a transfer to actually make the tax happen. And as you've probably guessed by now, the Income Tax Act has a very broad definition of transfer. It is way more than just selling something for cash.
I mean, a sale is obvious. Of course that's a transfer. But so is exchanging one asset for another. Or relinquishment, which is just a fancy way of saying you gave up your claim on an asset. Even if your rights to an asset are just extinguished, that can count as a transfer. See, the law casts a very, very wide net. And just as important is knowing what isn't a transfer. This is key. For instance, if you get an asset as a gift or inherit it, there's no capital gains tax right then and there. The tax only comes into play when you eventually sell that asset. The same goes for specific things like when mutual fund schemes merge. Okay, time to get to the heart of it, the calculation itself. We've got a capital asset, it's been transferred, so how do we figure out the actual profit or loss for the taxman? Let's get into the formula.
At its core, the math is actually pretty simple. You start with your sale price. From that, you subtract any costs you had to pay to make the sale happen, like brokerage fees. Then, you subtract what you originally paid for it. That gives you your basic gain. But for long-term assets, there's a powerful tool that can change this result dramatically.
And that tool is called indexation. This is a huge benefit, and it's only for long-term assets. Basically, the government gets that a rupee back in 2002 was worth a lot more than a rupee today. So indexation lets you artificially inflate your purchase price to account for inflation over the years, and a higher cost means a lower taxable profit for you. Now, this formula might look a little intimidating, but trust me, the logic is simple. You're just taking your original cost and multiplying it by a fraction. That fraction is the cost inflation index, or CII, for the year you sell, divided by the CII for the year you bought it. Let's see it in action with a real example. Let's imagine a pretty common scenario. You've got a house that was bought way back into 2002, 2003 financial year, and it's being sold now in 2020, 2021. The original purchase price was a cool 50 lakh rupees. Now we just apply that indexation formula. We look up the official CII numbers for those years, which are 301 for the year of sale and 105 for the year of purchase. We plug those numbers in, so it's 50 lakhs times the ratio of 301 over 105. And wow, look at that result. For tax purposes, that 50 lakh purchase is now treated as if it cost you over 1.43 crore rupees. Your cost base just shot through the roof, and that is going to slash your taxable gain. That right there is the incredible power of indexation. Okay, so you've calculated your gain, but don't write that check to the tax department just yet. There's one last crucial step. You might be able to shrink that tax bill or maybe even wipe it out completely by using specific exemptions the law provides. This table gives you a snapshot of some of the most popular exemptions. For example, under Section 54, if you sell a house, you can avoid tax on the gain as long as you reinvest that money into another house within a certain time frame. Section 54EC offers another path. You can invest the gain in special government bonds and defer the tax. The main idea is simple. The law wants to encourage you to reinvest your profits, and it gives you a nice tax break for doing it. So, to bring it all home, here's your simple 4-step checklist for any capital gain situation. 1. Identify. Is this thing even a capital asset? 2. Classify. Is it short-term or long-term? 3. Calculate. Do the math and don't forget indexation for long-term gains. And finally, 4. Optimize. See if you can use any exemptions to save some tax. And that's a wrap. But really, this is just the beginning. Knowing these rules isn't just about passing an exam, it's about becoming a much smarter, much more strategic investor. Thinking about holding periods before you sell or planning your reinvestments to save tax, that's what separates a passive investor from a proactive one. I hope this explainer helps you get there.